Good morning. This is Jim Colburn of Commodity Research Group. I'm here with Andy Lebow, also of Commodity Research Group. You can check us out on our website, commodityresearchgroup.com. We'd like to thank our friends at EKT Interactive Oil and Gas Training for hosting this podcast. This podcast should be construed as market commentary, merely observing economic, political, and market conditions, and is not intended to refer to or endorse any particular trading system, strategy, or recommendation. We are not responsible for trading decisions taken by anyone. Information is not guaranteed to be accurate. This is not an offer to buy or sell any derivative. Today is January 12th. Andy, good morning.
Good morning, Jim.
I guess our last podcast was before Thanksgiving, and that's when we had the Omicron price dump, and it's just a little while longer. Omicron is still out there, record infections, and yet the market is going wild on the upside. Take us through that.
The market has rallied more than significantly since the Omicron, since the November collapse. We're up. I'm looking at gasoline, where I'm looking at WTI. We're up 20-30%. WTI challenging 2014 numbers over $80. And certainly this type of rally was not expected in the least from those who were selling prior to Thanksgiving. But let's take a look at what's happened since. I think one thing on the demand side is the market has clearly taken the view that Omicron is not going to affect demand as significantly as it thought back in November or December, and that Omicron will be gone quickly, and demand should start improving as we head into later into the first quarter and certainly second and third quarters. So I think that's a big change. The other thing is governments are not doing full-scale lockdowns like we saw in 2020. Certainly China has been doing some severe lockdowns, but in Western Europe and in North America, we're seeing some lockdowns. Some travel restrictions, certainly, but we're not seeing those wholesale travel restrictions and lockdowns that we saw in 2020. So demand numbers, they've been coming in okay. I mean, we'll talk about the EIA later. The last 2 weeks were poor, but globally they've been coming in okay. And I think, and we'll talk about our expectations for later in the year. Secondly, certainly has been production issues throughout the globe in late December and in January. Actually, in December and early January, we saw issues with a number of non-OPEC and OPEC producers. Ecuador had a force majeure. Nigeria had a force majeure. Libya had a force majeure. Kazakhstan, there's been political turmoil, which led to production issues, freeze outs in Canada and in North Dakota, leading to some production issues in North America. And I've probably forgotten one or two, but certainly, those were real, and we lost barrels as a result. And that's given a fundamental underpinning, I think, to this rally, Jim.
Yeah. So OPEC has suggested they're going to produce 400. OPEC Plus produce 400,000 more barrels a day for 2 months in a row, and they haven't met those targets. Is that correct?
Yeah, they haven't come close. December OPEC production was up, according to Reuters, by about 70,000 barrels a day. And we're seeing some producers, the Persian Gulf producers, able to increase production, But the African producers, certainly Angola being one of the one that has really had issues getting anywhere near its quote. It's something, I think it's something like 500,000 or 600,000 barrels a day below where their target is. Maybe a little less than that. But the African producers have been unable to meet their increases. So as a result, OPEC isn't coming anywhere near what their targets are, and certainly the market has stood up here and taken note of these monthly OPEC productions, and I don't think of the monthly OPEC production, and I don't think as we head into February and March. They're not going to make another 400. Well, OPEC is 280 increase, and OPEC Plus is the other 120. And certainly OPEC's not going to make the 280 increase. And non-OPEC and the OPEC Plus is not either, because Kazakhstan is not increasing production, certainly in January or February or probably March. And Russia too is having some production issues. Of course, it is winter, but there's been chatter about Russia being unable to increase production as we head on later in the year. And certainly, again, there's a bullish underpinning to the market.
So you have demand holding up well and supply issues that may or may not be resolved in the short run. So that is telling me that we are still looking for stock draws in Q1, because it wasn't too long ago where, the EIA and some of the others were looking for builds.
Yeah, I think that what we're going to say, we still do. We can't just write off that Omicron's going to have no effect whatsoever on demand in Q1. And, I think as we head into Q2 and Q3, it'll have much less of an effect. But I think there is still going to be a demand effect. We're looking for stocks in the first quarter to be just about unchanged or up 0.2. What's significant, though, is that CRG has been steadily reducing that stock build. A month ago, I had the stock build at maybe over 1 million barrels a day, and now it's 0.2. It could go, it certainly could go negative. OPEC is looking for stock build. Well, they're probably around unchanged, and EIA also around unchanged. The big difference again is those are all, as you said, Jim, those are all builds. A few weeks ago, you're right. Everybody was looking for a build in the first quarter. So, I don't think we're going to see that. It's certainly, it's possible they end up as draws. And what's not interesting, what's really critical about that is, we ended the year with very low global inventories have drawn by globally probably between 1 million and 1.5 million barrels a day over the last through 2021. So we're heading into 2022 with low inventories, and we're really not going to get a chance. It doesn't look like we're going to get a chance to rebuild them as much as we thought, or if at all, in the first quarter of 2022. Again, that's bullish. That's bullish for price. There's a fundamental bullish factor.
Right. So this is just not going up on fund buying, although the funds have they've increased their length, but they still have capacity to buy here. It looks like at least from the futures chart, the February futures, it looks like we're breaking out over recent highs. I think if you looked at first nearby chart, we're not quite there yet, but funds, we're probably going to see some funds kicking in that we're probably kicking in as we speak.
Oh yeah, I mean, we had a big liquidation. I'm just looking at the numbers here, Jim.
Mm-hmm.
There was a big liquidation throughout October and November, to the point where crude got down to something like 5-to-1 long from 15 to 1 long,
Mm.
say, longs versus shorts. And now we're rebuilding the length throughout the first few weeks of throughout the last 5 or 6 weeks. The net length has rebuilt pretty significantly. Well, net is probably 10,000. So there's still room. You're right.
Still room. Yeah.
There's plenty of room for funds to get in. And you're right. And the other thing, Jim, you're definitely right. There, as we speak, I'm
Yeah.
sure they're just piling in.
Getting back to the EIA and the stock draws and builds, they're looking at for the year a stock build of about 500,000 barrels a day, and they have demand, global demand up by about 3.5, I think it's 3.6 million barrels. And my question to you is that they're also talking about a decline in price. I think they have Brent, going from like 79 to 71 throughout the year. And it's on an average basis, monthly basis. But it seems to me that even though you have a slight build, if demand is growing by that much, you're actually your day supply is declining. So basically, it's a tighter situation, not a easier situation. You agree with that?
Oh, that's such a great point, Jim. And I think we're seeing that you look at the structure, right? The Brent structure and the TI structure have both have gone vertical towards more and more backwardation. And yeah, I mean, day supply are probably going to stay, unchanged or decrease because demand is should grow a lot in the second half. So, under that scenario, it's hard to see like a major price decline. Of course, that's certainly possible.
Of course.
Um, as we know, I think, in the market, getting back to our own balances,
Yes.
I think when, the market looks that balanced and you're saying to yourself, oh, that's so boring. The market's balanced, it's not going to go anywhere. But if it's that tightly balanced, it means that if there's an imbalance event in any direction, you could see, a really volatile market. And, look, I know looking at my own numbers, I have a lot of uncertainty, and so does the market about where OPEC's going to produce. And of course, demand is never any walk in the park. So even though I think it's going to be balanced, wrong in either direction could be a big move up or down.
Yeah. The other thing is, in the EIA, they have surplus capacity for OPEC, almost 4 million barrels in 2022. So I guess that would put a little sort of cap on how high prices could go. Would you say, or do you think?
Yeah, a lot that capacity may get tested. I mean,
Right.
as we've known from the past, as as the spare capacity declines, prices tend to increase. So, we'll see we'll see whether the spare capacity. There's also spare capacity in the U.S. and Iran. There's a million barrels a day at least, or 1.5 million barrels a day of capacity in Iran. I don't know if that 4 million includes Iran, Jim.
I don't think it does.
Yeah.
Yeah. Yeah.
But there's spare capacity. Not that Iran is coming on anytime soon. And in fact, the EIA just said we don't see them coming on in 2022.
Right. And yeah, so that's kind of a wild card, and I guess when you have a position on, you always, if you want to say, if you don't believe the 3.9 number, you think it's tighter, you say you just don't agree with the assumptions and all that
Right.
stuff. But I guess the question is, would Saudi Arabia be willing to see prices get up to the $100, area before they released more oil than the 400,000 a month, I guess. So what?
Yeah, that's another good geopolitical question because certainly as both of us know, and you get over $100 and it sets off all kinds of alarms. That's big front page news in the Wall Street Journal and the Financial Times, and obviously gasoline prices would be much higher than what they are now, and I don't think it would be really good for Saudi American relations, U.S. relations, to see crude prices up over $100 or near $100. So, but again, if their capacity is tested, or if OPEC capacity is tested, that's a big issue.
Yeah, well, we certainly can't threaten anybody with release of SPR again. We see what happened with that.
Yeah, that didn't really stem the tide.
No. Okay, so since we're talking about production, let's talk about U.S. production's response. Can you just kind of briefly go through the EIA and basically what you're looking at?
Yeah, I was really surprised by the EIA numbers. They're looking for on production. I think they're much too low. The reason is that they have U.S. production for next year at 11.8 million barrels a day. Well, we're at 11.7 already. So that's where the exit is. Actually, the end of December was 11.8, and this last weekly for January 4th was 11.7, 11.7. So they have us basically with no growth for the first half of the year, of next year, and then we struggle up to over 12 million by November of next year, which would be a growth of only like 200,000 or 300,000 barrels a day. I think that's way too low. I mean, we look at where prices are now, and the rig count. I certainly think that production is going to be higher next year than 11.8 as an average. We're looking for about 12.15, which would be a growth of from exit. That's 0.35, but we basically have growth on production just about every quarter. First quarter could be problematic on if there are any weather problems, and of course you can't forecast. It's hard to forecast the hurricanes. Any hurricane issues. So I think they're way too low.
Yeah, I'm thinking maybe you might be a little low, Andy. To be
I could
honest.
be low. I could be low at 12.15
I mean,
for the year.
if you think about discipline, I mean, you keep waving candy in front of a kid who might have the best discipline in the world. At some point, he's going to grab for that. And I think if these prices stay high, I mean, do you think there's a bottleneck of being able to hire people in order to get to those products? Is there a bottleneck there, or is it?
Yeah, I think.
Discipline.
We have to give credit where credit is due, because the Permian producers and the shale producers did exercise amazing discipline, capital discipline, in 2021, much more than I think many in the market thought that they were capable of. And like you said, we'll see if they're where they're going to go in 2022. But yeah, I mean, they're definitely having problems on labor's a problem. Certainly, cost inflation is a problem. There were some reports that costs could be up as much as 10 to 20% this year. There's really, given where you see raw material costs, that's certainly possible, right? I mean, you could definitely see that, which would eat into profit margins. But down the curve, we're in the mid 70s, and mid 70s is a pretty good. You're still making money even with a 10%. You're still making good money even with a 10% increase in costs. So maybe you're right. Maybe I am too low.
I think that's going to be the surprise of the year, how these guys come roaring back. But I was wrong. I was wrong for a couple of years already. So I get one more year, and then I have to
Yeah,
stop.
me too. I thought we'd be way higher than where we're at.
So maybe some of the anti-fossil fuel rhetoric gets toned down after what's been happening around the world, especially in Europe, where they uh, natural gas was seen to be as an evil, you know, carbon spewing gas, and now it seems that it's much more acceptable, and even nukes are being much more accepted in Europe. So maybe there's less sort of pounding of by politicians of oil companies this year when we kind of need the barrels. I don't know.
Yeah, that's hard to say. I mean, if prices, if gas prices start moving towards, close to $4, the one, you, you know who the, who the boogeyman is. It's always the oil
Oh
companies.
yeah, the price gouging. Yep,
Yeah, price
yep,
gouging.
yep.
They're making too much money, et cetera, et cetera. So I don't know if that, you know, if the haters are going to let, are going to let the oil companies off the hook.
Yeah, produce more oil. Drill, baby, drill. What else, Andy? Gasoline demand. How's that? You said demand's holding up. I assume you mean
It
gasoline
was
real.
holding up. The last 2 weeks have been horrendous
Yeah,
for gasoline demand. It's that we're into the end of the year, and it's hard to that you had like a 8.1 and a 7.9. It's really low numbers, and the week before it was I think 9.7. The 4 week average is low at 8.7 versus a 5 year is like 9.1. That's million barrels a day, 9.05. But again, you have two squirrely weeks in there, which showed gasoline stocks up to 18 million barrels over the last 2 weeks. So it's hard to get a picture. December ended up being pretty good on demand for on gasoline demand. We'll see. It generally weakens in January and February. That's seasonal. But bigger trends, I think that we're not seeing. I think we're going to see miles traveled increase this year as more people take vacations. The job numbers are still very strong. So there's still job creation, and that from a macro standpoint obviously is going to be constructive for gasoline demand. On the bearish side is the pump prices really didn't come down all that much, and there could be a slight demand effect on the downside. But I think overall we'll see a decent year of growth for gasoline demand this year. Globally, I think that Asia is going to see a really good year for gasoline demand growth, because there were lockdowns in third or fourth quarter throughout Asia. Maybe not so much in for China, but I think Asia is going to be pretty is going to see some decent demand this year, and Europe too. Demand should be okay. So gasoline demand, I think we're in for a good year this year, Jim.
and what about distillates? I mean,
Distillates too for diesel. Well, heating oil. I mean, diesel's going crazy right now. The the big story is it finally got cold here,
yeah,
and the dealers in New England where demand is just about the strongest. There's stockouts going on. So inventories for diesel and for diesel are low in Pad 1, and pretty low in Europe as well. So we're seeing pretty strong demand, and at least right now, and certainly diesel is very is highly correlated to the economy. The GDP has been marked down, I think. I think the World Bank just marked it down to, I think it was 4.1 from 4.4, Jim, if I'm not mistaken. But, you know, the 4% growth is still, it's not as much as last year, which will probably end up being closer to 6. But, you know, it's still a pretty good growth, and diesel should, you know, that's going to help. That's going to help diesel distillate demand globally. So, you know, we should see decent demand for distillate and petrochemicals also. I think we're going to have a good another good demand, particularly in the U.S., where we've got some new crackers getting ready to, you know, getting ready to, or
Crack.
being, yeah,
Crackers want to crack.
the crackers want to crack. So I think there's going to be, you know, there's going to be, at least the EIA is saying, and I do agree. I think ethane demand is going to be off the charts in 2022 in the U.S. and globally. It should be petrochemical demand should be very strong if the economy's up 4%. Maybe not as strong as this year, but still, you know, at least by a growth standpoint, it'll still grow, but not what we did. What we did this year.
I was looking at that other oils indicator in the or category in the weekly numbers that came out this morning, and it shows the 4-week average is up 11.6% from last year. That's a pretty good jump.
Yeah,
and it's, you know, it's 5.7 million barrels a day of, they call product supplied, maybe implied demand. That's becoming a bigger and bigger part.
oh my goodness, definitely.
Right.
You
That's
know, right.
second to gasoline now.
Yeah,
I
that's
mean,
all the AIM. Well, not propane, but you know, a lot of the NGLs
yep.
except for propane and propylene.
Well, the hydrogen.
So
Yep.
yeah, that's a bigger and bigger number.
Yeah. And that's it seems to be booming in demand.
So Jim, let's talk some options.
Yeah.
What
Well,
you know, what are we seeing in the options world? Are you still seeing that bullish sentiment you've been talking about?
yes and no. It seems to I'd say on this rally, obviously I don't know the minds of people who are trading this stuff, but just taking it from a macro, you know, view, we finally had a decent volume day yesterday. And so you had more calls than puts trade. And I'm talking about Brent plus WTI. So figure about 180,000 calls traded for both of them and about 150 puts, so a little bit more calls. And they're balanced pretty much on new open interest. And so you had in Brent, you had 20,000 new calls, about 20,000 new puts. In WTI, you only had 11,000 new calls and 24,000 new puts. So it's kind of, you know, I always look for like extreme situations. Yesterday was kind of interesting because we had, you know, the call volume was around 53,000 for Brent, and open interest actually declined. So in that case, I think what was happening is you saw some June calls being sold out and maybe rolling into December. So I think there's a lot of people with positions on the upside calls, and as this market moves, they start kind of rolling up and down and out, and that's what it looks like to me. But we're seeing at these levels increased open interest on the puts, and that tells you that, you know, that's probably, obviously speculators are in there, but also probably some producers are coming in to hedge, going out for this year and seeing good prices. So we'll see if that continues. Like I said, the volume hasn't been that great over the holidays. The implied vol it got up to 67.5 end of November on that price dump, and now for WTI, and now it's around 37.5 for Feb, 35 for March, and that's more of a, you know, long-term average. I use like 33% for the long-term average. You know, the market's rallying, which tends to put a damper on vol. But out in December of 22, vol's up to 39.2, which is kind of high to see in a market that's rallying. So it's probably put buying and call buying in December of this year. But again, it's just I wouldn't say there's a lot going on in the world of options except for maybe yesterday. We'll see if it's a trend. Let's pick up in volume.
I'd suspect that, yeah, I mean, it's interesting you say that you're seeing interest on both sides,
Yeah,
right?
yeah,
And you would think that producers, as we get up here, that this is a, that they're going to want to look at least down the curve, you
yeah.
know, the,
Kind of look for things that are unusual. So if the market, let's say the market trades down sharply like it did in November, you would expect implied volatility to go up. But what happens if the price trades down and volatility goes down? That's something that's sort of odd. And the thing that would be odd, is kind of odd now, is if the market goes up and you begin to see open interest in like good volume and calls, and open interest goes down. Now that wouldn't be odd as if you're coming up to expiration. You see a lot of that, people liquidating front month options. But on Monday we saw June options being liquidated in Brent, and it's just something different than what you normally see. So that's kind of stuff I look for.
and the vol in second month
Uh,
March is
35.1. So it's not much different than, say, I would call that average volume. And if you want to go a little deeper, we've seen a rally. So what would you expect to happen with the skew? That's looking at the, say, an out of the money put vol versus an out of the money call vol. You would expect that to come in, and that's what's happened. We've gone from like -14 a week ago to like -8, and that's on a June contract. So that's
yeah,
kind of,
that
yeah.
right. Yeah, that makes sense.
Yeah, it's like you know, dog bites man. It's not news. If it's man bites dog, then it's news.
Well,
Yeah,
one thing that, just to add from the conversation, is you're getting a lot of analysts coming out with pretty pretty high numbers.
yeah,
I think you're getting analysts who are, not universal, but we're getting a lot of hundreds,
yeah,
out into the market. And one analyst yesterday started talking about 114 for 2023. So, that's out, that's
yeah,
out there,
yeah. And
right?
it's,
That
yeah.
gets into the market's consciousness.
I think yes, it's interesting. These aren't people that you're pulling off the floor who are looking at their point and figure charts. These are real, like they're barrel counters. Not that that's a better way to predict price than point and figure charts. I'm just saying these folks, they count that, like you. They count every single barrel. They're not crazy people that.
No, in fact, there's two of them in particular that I highly respect.
Yes,
That do it's good. Exactly, Jim. They're barrel counters.
right.
It's not out of nowhere that they're coming out with this number.
And we do have some
And
permables.
it's
So
not a permeable.
no,
No,
right.
clearly not. They're definitely not permeables. So, that's it. That I think is another factor.
Yeah.
That's out there.
Well, I
You
tell you
know,
what makes me nervous, Andy, is my view is kind of rolled into the consensus that this thing is moving higher, and that's what makes me nervous. So
yeah.
that's when I start looking to buy puts.
That is exactly right. I
Right?
think you've been very good over the years for pointing out some great contrary indicators, besides sentiment.
Yeah.
When certain sectors of the market decide it's time to hedge, and inevitably it's
Right.
it's a wrong way hedge.
Well, we had one customer a long time ago who said, I don't know where prices are going, but I know where they're not going, and they sold a boatload of out of the money calls, and I wanted to call up and he said they're never going above that price, and I said, oh boy, I want to call my grandmother and take some money out of
Right.
her account and buy those calls. But anyway, yeah, you get those when you hear those, you know, when everybody's on the same side of a market, you beware. And I'm not quite, it's a degree here because some people are bullish, but some people aren't as bullish as those folks you just talked about.
Right, right, right. And there are bears.
And there are some bears out there. Yeah. Yeah. I mean, and like you said, Andy, you're the good point about Omicron. It's not done yet. And then we don't know what's behind Omicron. What's the next variant that's poking its head up? Is it going to be deadlier? I mean, did we just get lucky with Omicron? And when I say lucky, I mean that it's not as vicious as Delta. And although you can catch it easier, we don't know what's behind there. And then also things like the Fed. We don't know if Russia's going to move into Ukraine. There's all these things that are in the background. We don't know what Iran's going to do. That's why we like watching this thing.
Yeah, and as we've learned over our long and somewhat distinguished careers, the big surprise is something that you're not focusing on,
Right.
right? That it just comes out of nowhere,
Yep.
whether it's infrastructure or something. You could say geopolitical infrastructure, but it's always something that you really hadn't anticipated would happen.
Well,
And
I do believe I knew you, Andy, before you knew where Carg Island was.
yeah, right. I think you did.
Yeah,
Stuff
takes you around the world, right?
And it comes back, right? It comes back every decade or so. Well, actually, we've never stopped talking about it, but yeah,
so
Island.
just maybe finishing up here, Andy, what's your price projection? What kind of range are you working with, or what are you seeing for just next month or two?
I think the market, I don't see it going to 100 by end, at least this quarter, or I'm not really looking for it for this year. This rally, frankly, has it has surprised me, and it does look as though we have a chance to. Well, we're in the mid 80s now. We're moving into the mid 80s right now,
Yep.
Which really was my projected high, Jim.
Right.
was mid 80s, so we'll have to raise that a little, maybe maybe up to 90 for the next couple of months, because we're pretty close.
Yep.
Here, and certainly we get any type of surge on production, or we start seeing some of the non-OPEC and OPEC producers able to increase more than we thought, or U.S. production in particular to increase more than we thought. I think the market could certainly get back into the lower 70s.
You're
Lower to mid 70s, something like that, which is a wide range, but I think that fits with some of the uncertainties coming up. And as you mentioned, from a macro standpoint, the non-oil, and non-oil standpoint, there's certainly any number of things that could that could derail this rally.
So if I were to say to you, let's say the current price is around 85, we're at 83 actually. What's higher probability over this year, or which price comes first? Put it that way: $60 or 110?
I would. That is. I probably bet on the lower price rather than the higher price, and I think the reason is there's too much. As you said, Jim. The crowd is on that 110.
Right. Yeah.
So hardly anyone is talking about $60. Do I really think it's going to get down to 60? That could be a macro. Something would have happened, as you were saying. That could be another virus that's worse than Omicron. Another variant worse than Omicron, or something like that on the end use.
Very good. Let's wrap it up, Andy. Anything else you want to talk about that we missed? Sure, there's
No, I think, well, there's plenty that we missed. I'm sure, Jim.
Yeah.
And there's plenty people probably want to hear. And I think, as we move into this year, I think we're going to try to talk more. We're going to definitely get somebody to talk about LNG
Oh, yeah.
and another natural gas. Last year we talked to Stephen Shork about natural gas, and
Oh, yeah.
we'll try to get another, another analyst to talk about natural gas and LNG. And we will definitely be talking more about the transition, as it begins to unfold.
Beautiful. Okay. And you can find me at commodityresearchgroup.com, or I'm on LinkedIn as well. Look me up.